Let's understand from our experts at this point of time that what exactly is happening in this market and how they are dealing with it. Kunal, before I get into stock, queries, are you seeing, this as a bottom formation process, or this is just a bounce back to the factors which I just mentioned, that expiries and other things, short covering happening at this point of time, long weekend, or you feel that after this bounce back, there can be a substantial correction again?
Well, I think you should take it as as it comes, for the market, because I think the last 2-3 weeks we've seen almost on a trot, consecutive selling for the index. So even if it's a 100-point, 80-point recovery on the index, you can't categorize it and say that yes, it's a bottom formation process. It should take a lot of time theoretically as well. And I think even if the index consolidates, which I believe broadly that is what I think the pattern should be for the next couple of days, this 10,000 mark should act as a pivot point. So maybe 100 points, as you flagged off in the morning, that 120 point straddle on the index. I think that could be the range for the index, at least for the next 2-3 trading sessions. So don't be very extremely exuberant. I think it's just that the stocks are showing some sharp and positive reaction. So try and ride these stocks, and then expect that if the index consolidates and this consolidation gets over, then you could probably look out for some more signs of positivity on the upside. As of now, remain stock specific. On the index front, I believe we should broadly consolidate.
Okay, Dr. Nayan, looking at your stocks, buying a Cadila, a pharmaceutical name, and selling an OMC, which is more to do with rise in crude oil prices, is it like you too are feeling that this bounce back is just a bounce back and not a trend reversal, and probably we should wait and watch these 3 days and then take a fresh call on indices next week, and your rationale for Cadila and Chennai?
Well, I would completely be in agreement with that point, that we should wait and see for these 3 days and not really jump to any kind of conclusion about the return of the uptrend, as it were, because there is no denying the fact that today's trading seems to be, kind of revealing some amount of bullishness. But that has to be placed in the context of what we underwent in the last week. Now, if you noticed in Friday's trade, I think almost all the stocks, barring perhaps some Chola Finance and maybe one other, I think the rest of the stocks from the future space, all of them had shed OI. And that clearly signaled that, there was long liquidation and substantial amount of positions, even perhaps some shorts were also cut. So the market today was really largely devoid of too much of position, and that is why right from the start, when the market did not fall, I think some amount of rise and some amount of replacement buying has come in. There is nothing aggressive, so like I think Kunal said, we have to be very, very stock specific, and wherever some sort of pockets of consistency are visible, I think that is where we would like to go. And coming to the two picks, Cadila and Chennai Petro, I think the short in OMC stocks kind of picks for itself, because that's an area which has remained weak. BP is looking weak, HP is looking weak, and so I'm choosing Chennai Petro for some further decline from here to about 305, 307 levels. Keep a 5-6 rupees stop loss. The reason for buying into a Cadila is that there is some amount of news flow today which seems to have arrested the ongoing decline in that stock, and this big decline of multi-weeks has come to a zone of support, retracement support also. So combined, the two together could probably produce a little bit of bounce from here. It's a low risk bet, therefore 386.87 current price. Buy it for a 10 rupee advance at the minimum, stop loss at about 380.
It's also welcome Manav Chopra into the discussion. Manav, I'll come to your stock, I'll come to your market view, but you are betting on some of the consensus trades like Bata India. Since morning we have received many calls on that. Bata India is a buy, and certainly because the volumes and the price move which it's showing, and Titan, irrespective of market correction, this stock is not showing any signs of correction, and the stock is doing pretty well. These two are buy calls for you. What are you seeing on charts?
Absolutely. See, looking at the charts perspective for Bata, the stock has been in a series of corrective declines. So basically, Bata has been in a very good primary uptrend since last few years, and we have observed corrective decline in Batas from the highs of 832. And looking at this chart in last couple of trading sessions, the stock has managed to exceed important levels and has breached the falling trend line, which confirms a medium-term trend reversal, definitely, which has been confirmed by volume. So I think going forward, Bata definitely has formed a higher bottom, and there is limited downside from the current level. So going forward, one can definitely maintain a buy on dips on Bata, keeping a stop loss of 710. But I think in a medium-term perspective, I wouldn't be surprised to see Bata testing the levels of 830, but for the medium term perspective, for immediate basis, 770 would be the immediate targets. For Titan Industries, the stock has been in a very good uptrend and has been forming a series of high tops and bottom consecutively. The momentum is with the stock, and as the stock is making new highs, the volume is also further confirming. So in such markets, I think it's also important to have a momentum play going, and since the stock is also seen a good new high forming in next few minutes, we've already seen the stock breach its previous highs of 938. So I think going forward, this stock would continue its outperformance. We can expect the targets of 965.
Kunal, you have been optimistic on TV18 broadcast, a couple of weeks back as well, but correction did set in, and this was not a correction actually, it was a consolidation, I would say, and now again a big green candle. Do you think it has potential to move above this previous highs of 6970 zone and give a breakout? And interestingly, Bank of Baroda, you think these are fresh longs or fresh buying which is taking place? Because as I was putting forward an argument or that point, that it is short covering which is taking place, and most of the short positions are in PSU banks. So is this a durable rally according to you, or you are just playing for a bounce?
Well, yes. So first on TV18 broadcast, it was more of a pause which happened for the stock. I think a couple of weeks, last week, approximately, the big rally which ensued into the stock from 50-55 levels to almost 65 plus, and then the stock took a mild bit of pause, retraced back to its minor moving averages, and now it's looking very strong again. So structurally, the stock pattern is on the bullish side. It's just that that consolidation is one of the sort of triggers to buy the stock once again, and expect that the structure would continue to be bullish for the stock, and that is what I'm expecting for the stock to behave, suggesting about with 75 as a target, stop loss at 62. And the second is Bank of Baroda. Now, yes, most of these PSU banking names are showing some fresh signs of recovery. Bank of Baroda also, I think, had shown some good signs of recovery a couple of weeks back as well. But I believe that this could be a sign of even a short-term uptrend. The volume patterns, the fact that these stocks are not falling any further now, gives a sign that maybe these stocks are ready to go for a short-term uptrend. So that is what I'm banking upon, suggesting a buy on Bank of Baroda with a target of 155, stop loss at 132.
Okay, after all that technical talk, let's also get on board Anand Tandon, independent analyst, to track the fundamentals. And Anand, with the trade wars, the rising bond yields, the way crude oil prices are moving, and the fact that we're so contingent on what's going on across the globe, it would make a case for one to be fairly negative on the markets despite the kind of short bounce back that we're witnessing in trade right now. Is that the sense that you're getting for the rest of the year?
Certainly, I think we have a combination of negative macro domestically, possibly negative flows into the market. For a change, I think for the last few days, I understand that the flows into the mutual funds have become somewhat muted. And I was actually waiting to see what would happen in April after the tax-related savings were out of the way. I think that will be a large indicator. Plus, of course, the fact that the global markets continue to remain in a bit of a tizzy because of the trade wars initiated by the US. And the question really you have to ask is whether this will get worse from here. I would think right now the balance is in the favor of it getting worse by at least 60% to 40% against.
So what is it that you're advising one to do at a time like this? Would it be completely sitting on the fence, or would you be looking at some opportunities when it comes to fundamentally strong companies on a decline?
But two things. One is, if you are not necessarily a investor in the market and are looking at it as somewhere where you're putting your money, then perhaps an SIP which you might have been doing should be continued. If you are, however, looking at opportunistic trades, I would hesitate to start right now, because while I think the next 2-3 days may actually be on the way up, because it's been oversold, and also we are coming to the end of the financial year where a lot of mutual funds get active in protecting their NAVs. The reality is that I think the market has the potential to slip down further. One should not be anchored to the recent high prices you may have seen in January. Those are irrelevant. The reality is that you are in most cases down only to what was perhaps September or October of last year, and those were already very inflated prices in terms of valuations. So I think, if you are actually looking at valuations, don't just go by the fact that many of the stocks have corrected 15 to 20%. Wait, because you may actually find that they get cheaper from here.
Anand, do you think or sense that there could be any opportunity at maybe some more levels further below from here, but in the private corporate banking names? Or do you sense that the fear that some of these private corporate names, and large ones at that, could be linked to some of the tainted accounts and the skeletons are still coming out of the closet, so that's a space that you would still stay away from?
Clearly, corporate bank is one area where, at some stage the market has to turn around, and probably the worst is apparently in the price. I mean, take a case like State Bank of India, for example. You can choose whatever number you like, but the valuation for their subsidiaries can be anywhere from, let's say, 60 rupees to 100 rupees. And their core business, if you were to assume that there is 100% write-off of all known and a few unknown NPAs, it would still be valued at, maybe 150 rupees or thereabouts. So if you're looking at, let's say, 2020 valuation, the worst case, everything wiped out, would be not less than, maybe 200, 225. You're not very far from there. Now, if there is a real panic in the market and it comes to below that, which is possible, that would be a great buy, and that is where the opportunity would be. Even otherwise, I think, it's likely that these kind of stocks would be outperformers from here rather than continue to drag down, because all said and done, if you are going to bet on an economic recovery this year and an earnings recovery this year, it cannot happen without the corporate banks finally starting to show some signs of life. Broadly, if you look at the index itself, most of the private sector, the public sector banks themselves are supposed to be almost, a mid-teen kind of reason for the earnings growth. So if that were not to happen, you would have to bring down your EPS. The short answer is, I think large corporate banks, corporate-facing banks, which have most of their NPAs declared, are possibly a place where you should start sipping, as it were, if not actually going out and building a decent-sized position straight away.
Yeah, in fact, talking about corporate banks, Kunal, we've been monitoring the corrections on SBI, which is already at a 52-week low, or for that matter, an ICICI Bank, wherein that it doesn't seem like the correction is quite done yet. Do you sense, though, that in the next 2 days, perhaps, you could see a short covering-led bout as we begin to settle in for the next series?
No, Aisha, yes, for ICICI Bank, I would, sort of strongly agree that these stocks, that stock particularly, is coming back into its key support zone. Now, in technical terms or in technical parlance, we call gaps or stronger gaps on daily charts, which have, sort of higher magnitude. They act as, key supports, and I think for ICICI Bank also, I think as we discussed last week as well, when I had given a contra buy call, that the stock is entering into a key support zone, a key gap zone. Generally, gaps act as very strong support zone, and also, given the fact that the stocks has already seen a sharper correction the last 1.5 or 2 months, more in sync with the market. This and now the stock into the support zone gives an indication that you could see a bounce coming in to many of these private sector banks as well. So yes, the first leg of the rally is led by more PSU banks, but I believe the durability of the move, which I discussed at the start of the show, that you need to see more positive signs coming across from large cap names, and that signs or those signs would come when you see private sector banks like ICICI Bank, Axis Bank, which have been taking the heat in terms of selling pressure. If they start to rise further, then you could see more durability in terms of index moves. I believe as of now, in terms of chart patterns, ICICI Bank looks very strong at current levels, and if you're a short term or a positional trader, I think you can keep at least a 260, 265 as a stop loss and look to go along at current levels as well.
Okay, seems like ICICI Bank in the near term at least is going to continue to see the bounce which it is today, holding up by about 1.25% after an extremely rough fortnight that the stock has had. Actually holding up pretty okay even for the markets. Guess what? After sub 10,000 levels, the start of today's trading session, we've made it back to 10,100. The breath as well is opening up, but let's see. You never know how long this move actually lasts. Maybe the last half hour could turn up something completely different than this. Hopefully not. Let's keep our fingers crossed at that. For now, we're going to take a very quick break. When we come back, get back with our chartist and Anand Tandon.
Hello and welcome back. You're watching ET now. 110 points up for Nifty, and look at Bank Nifty, almost 500 points rally, 480 to be precise. Well, it won't be a fair assessment if we say that this is just a short covering rally, because three names which I could see on my screen where there has been whatsoever no shorting which has taken place in last few weeks or so. Firstly, HDFC Bank, HDFC Limited. These two names have not seen any major shorting taking place. They have been in a range, and now from lower side of the range these stocks are moving on to the higher side of the range, and there is no denial of this fact that HDFC Limited and HDFC Bank are key contributors towards indices, whether it's Bank Nifty, which HDFC Banks contribute, and both HDFC Bank and HDFC Limited contributes towards Nifty. One more stock, auto major Maruti. Now that stock is, yes, it has been, a bit underperformer, but there has not been a, a major correction as such. There has been a downward trend, but no major shorting, and there too, we are seeing almost 2% up move over there, contributing towards, gain in market. So these are few pockets which surely are not rising because of short covering. Let's take some more trading ideas at this point of time. And Dr. Narayan, M&M Finance, this is one NBFC which you have been quite optimistic of late, or I would say in last few months when NBFC space as such was going through troubled times. This stock has been an outperformer, and you feel that it would continue to do well?
Well, I think at the moment, Siddharth, we are, trying to look for stocks which are showing some unwillingness to decline, or rather trying to stem that decline, so that as and when the good times come back, these may be at the forefront. And among that lot, I think Mahindra Finance would probably be among the stocks which would fit such a bill. I think at the current price of about 438.39, it seems to be a low risk share to buy into. So I would suggest buying with a 6 to 7 rupees kind of stop loss at this level, and we can look at a price target of 445, 450 by maybe today, tomorrow.
Before I take more trading ideas, I would like to bring Anand into discussion. Anand, you have been a bit skeptical on market from valuation perspective, from liquidity flow perspective. How are you reading this entire bounce back? I know it's just a one-day move, and it won't be fair on my part to ask you about one-day move, but do you think that this is more to do with what's short-term? Maybe market was in oversold zone, and still we are not yet out of woods, because be it tariff war, be it right now we are not discussing too much about the impact of higher crude oil prices on the fiscal match when it comes to our markets. You think that going ahead, if geopolitical tensions rises further, because I don't think so, this demand of crude oil price, this hike in crude oil prices is because of significant demand. It's more to do with what's happening between Kuwait and Iran, and also decline in production in Venezuela. How this math would change the story, the macro story for us?
Well, the macro story has been deteriorating for a while now, and obviously crude is a huge negative if it goes up. But frankly, I don't think macros plays much of a role, at least in terms of stock market performance in the near term. That can make a difference over a very long period of time. By and large, when there is a weaker macro, it usually means that there is a greater amount of money in the hands of the residents, because the government is not taxing you to the hilt. Usually it comes with fiscal deficit. Of course, if it comes from domestic lack of raising taxes, that's even better. By and large, what we are really looking for is job creation. And frankly, I have been very skeptical about this huge drama that the economists put up, that we should worry about fiscal deficit at a time when the economy is clearly working at very low capacity utilizations and large amounts of unemployment of various kinds. So I am not much worried about the macro. I think purely from a micro perspective as well, the key thing is, will the earnings earnings come through, and at what price you're willing to pay for it. To my mind, interest rates are a far more problematic area, and that is driven much more by global factors than domestic factors for now. We've had the case where RBI has been trying to loosen or tighten, and the market has a mind of its own, which is the way it should be, frankly. The global market tightening can be the biggest trigger on the way down, because if you actually have a significant uptick, you already had some, but a further significant uptick in terms of yields, the amount of low-cost borrowings that people had been sitting on will suddenly get repriced, and many companies and countries will actually again begin to look rather unstable. I don't think India will fall in the very weak category just yet on macro, but that alone is a good enough trigger for flows to reverse, for flows to move out of many marginal countries, and for generally the situation to look much worse. And within that context, I would look at the Indian markets in terms of its own liquidity, in terms of both the higher interest rate as well as the fact that people have been buying mutual funds on an SIP basis as if it was fixed deposit. In fact, I believe that many banks have been selling it as an alternative to fixed deposit by saying balanced funds are a great 1% a month kind of opportunity. Now that, for the first time, if you look at anyone who has been doing SIP for the last 12 months, is actually beginning to see negative returns. That, to my mind, is a far bigger risk, that if there is an outflow from the market, then this could be getting exacerbated.
Anand, just wanted to get your sense on what spaces should be avoided now that there is that still impending fear of perhaps a trade war between, to begin with, just about, US and China, and that could pilfer through to some of the other countries as well, perhaps. There was a note from CLSA this morning, pretty interesting one at that, categorically stating that stay away from IT, stay away from pharma, individual names like Tata Motors, Bharat Forge, or for that matter, Motherson Sumi are also likely to be impacted. Would you concur with that thought?
So that is on the basis that you are assuming that some of the trade war effects will come to India as well. If you were to make that assumption, then you are in serious trouble anyway. I think the more immediate impact that we are beginning to see is, of course, between US and China, and perhaps at the next round between US and EU, where some of the companies like a Bharat Forge or more likely a Motherson Sumi, which has production centers in Europe and is supplying to some European firms, to some American companies, etc., may be more directly impacted. I think the second order effects in terms of IT and textiles, for example, which if it were to affect India directly, would be a problem. But I would be a little more sanguine at this stage, because I don't think that the US can pick up a fight with everybody around the sun. They have to leave a few, and we are not yet a large enough player for them to worry about us in the immediate near term. We could actually reduce the import duty on Harley Davidson, since that seems to bug the US president a lot, and just say that, okay, we want more fuel efficient bikes, and you'll still not get any imports of Harley Davidson.
Right.
So I think, the real issue is how much of the domestic business you can do. I would still continue to bet on things like pharma, etc., on a longer term basis, because I don't think you can get away from the fact that it's the largest production facility.
Yeah. Let's take more trading ideas at this point of time. And Kunal, though we were talking about that consolidation and probably mid caps would do well, large caps are doing very well. 120 points up on Nifty, 500 points on Bank Nifty. Your other trading idea is from auto ancillary space, Apollo Tyre. What are you seeing on charts there?
Yes, Siddharth. So this is also one of the fewer mid-cap names rather that has not corrected significantly. In fact, the best the stock has done in the last 2 months is just to remain very sideways. It's a high beta name, so a high beta name remaining into a very tight range for a market which has been extremely volatile, I think says a lot. And now when you're expecting some bit of recovery happening into the indices, this stock is finding some key supports and rising up higher. It's on the verge of breaking this downward sloping consolidation trend line, which is at 270, 268 mark on spot levels. So I'm preempting the breakout on Apollo Tyres, suggesting a buy with targets of 285, stop loss at 265.
Manav, two-wheeler space, and I'm talking about all two-wheeler space over here, Hero MotoCo, Bajaj Auto, TVS Motor, these stocks have shown substantial correction and in some of the cases have underperformed markets. Hero MotoCo, you think you're giving a buy call, you think it's a trend reversal now, or you're just playing for a bounce?
See, at the current levels, the stock has actually observed a series of decline. Since last 9 trading sessions, the stock has declined from the levels of 3,700 and has seen a good base formation and a very strong reversal, at least on the daily perspective. So the overall trend for this stock remains bullish, and the stock has bounced from its weekly oversold level. So I think at the current levels there is limited downside, and also on the oscillators front, with the formation, I think it's a good entry point at the current levels. I recommend a buy into this, keeping a stop loss of 3,400, and expect the levels of 3,600, and once if the stock even manages and exceeds 3,600, I think the stock has a potential to even test the levels of 3,700. So I think at the current levels, the support for the stock of 3,400 can hold for at least for a near-term perspective.
And Dr. Nayan, I did ask you about M&M Finance, which was your 255 idea. But any large cap which you feel can, probably not is rallying, not just because of short covering, and apart from the names like HDFC Limited, HDFC Bank, Maruti, where you feel that the bounce back may last for more than one day?
Well, I think for that you'll have to go into those which have been experiencing a good uptrend already. See, if the market is in a mood to rally, and maybe you'll do it for a day or two more, let's assume that, then it's better to go with stocks which have been rallying, and in that I think only two names clearly stand out. One would be Jubilant Food, the other would be Titan Industries. Now these are two stocks which have been carrying on with the uptrend even during the time when the market was somewhat softish or pressure to the downside, and today also they are seen to be at the head of the pack in terms of advances. So I don't see any reason why the bulls would want to shift their focus out of these stocks if the market is in their favor. So if at all, I'm inclined to go long and push further even at these levels on stocks which have moved higher. These two would be the names, Jubilant Food and Titan Industries.
Caps and mid-cap stocks have done really well for themselves, and Jubilant and Titan have been adding a lot of long positions in future segment too, and technically our experts have been suggesting to go long over here. Anand, on this note, I would like to thank you for joining us and giving your opinion on markets and some of these sectors. Let's take a quick commercial break. On the other side of the break, will this move, which maybe because of short covering, will sustain at higher levels, or we'll see intraday corrections which we have seen in recent past? So stay tuned.
Welcome back. This is Closing Trades, and we're definitely taking heart from the fact that what started off as a choppy session sub the 10,000 mark has now gone on to see quite a U-turn or reversal, if you will. 10,113 is the level that we're staring at on the index, and it's the PSU banks and financials in general that have managed to see a good leg up, and that's supporting the markets as we speak. Of course, the question maintains to be seen whether or not this is just a short-term blip or whether we can see some sort of a decisive trend. But for the moment, I'd definitely like to pull up those financial stocks. Check in on a Canara Bank, which is showing you a good leg up, 9% on that stock. Bank of Baroda has piled on a good 5.5%. You've got Corporation Bank doing its bit, SBI, Bank of India, you've got an HDFC Bank, Andhra Bank, and something like a GIC Housing Finance as well, which is showing you quite a bit of conviction. Within the pack, Kunal, are there any names that catch your eye, even some of the housing finance names that are managing to see an up move?
Yes, one, I think, I'd go with a couple of names, in the space. One would be Bajaj Finance. I think the stock is, looking very strong. It's a large cap name. It has remained extremely sideways, for last two weeks approximately. And now I think, with the index stabilizing, you're seeing some signs of strength building up into the stock, volume-wise, pattern-wise, price pattern-wise. I think it's looking very attractive for a good breakout. So almost a 5 to 7% breakout is what I'm expecting for Bajaj Finance. And going into the tier 2 names as well, and some credible stocks there. LIC Housing is one of the few names. I think we discussed the stock in the earlier show as well. Siddharth, and mentioned that the stock is ripe for a big breakout on the daily hourly chart. So that could also be one of the other stocks which a trader should be looking at. And yes, in terms of the PSU banking space, these stocks are finding some very good strength. So look at it in terms of the last 7 days or 8 trading days. They've seen almost 2-3 big days of stronger price action. Yes, these stocks have not seen a follow through, but the fact that there is a persistent comeback into the prices, and these prices making big intraday gains, I think is a sign that a short-term bottom could be in place in individual of the stocks. So you have to be very choosy and selective with the kind of stocks you pick in the PSU banking space, but I think there could be money made on the long side in this trade, at least in the very near term.
Indeed, otherwise, in the space that a lot of people are avoiding right now, one needs to be very choosy and picky, says Kunal. But let's listen in to one of the biggest global voices as well that we spoke to on ET Now, Mark Faber. He's better known as Dr. Doom, but he decodes the global meltdown for us, saying that the trade war scare will end up denting global growth, but at the same time he points out that the correction in the markets does not have a serious undertone yet. He's bullish on the India story in the long term. Let's listen in.
I was expecting a correction a long time ago. It hasn't happened, but when it then happens, it happens more severely. But it hasn't happened yet very severely in the US. We're down actually not even 10% from the January 26 high. In India, we're down about 10% from the January 29th highs. But it's not yet a big correction by historical standards. A correction would be, say, a 20% decline, and the bear market would be something like a 40% decline. So it's nothing very serious yet, but it may become very serious in future. Well, I mean, I think that India, from a longer term point of view, is still an attractive proposition. But as you know, India is not exactly a problem-free country. And there is leverage in the system, and there has been fraud, as you know. And there are still some unsettled political events that may happen. So I'd say, given that the market has actually rallied very strongly over the last few years, and that we reached a high here at 36,400 on January 29th, I think we could easily decline by around 20% from the high. That would take us below 30,000. Long term, as I said, I'm optimistic, but I think we have to realize if one asset class goes down, fund managers will also sell another one, even though the fundamentals may be favorable, but they just get out and build up their liquidity, because on the institutional side, the funds are holding very little liquidity. So they may build up liquidity, and that can then bring about selling pressure everywhere.
Okay, that's the view coming in from the author of the Gloom, Boom and Doom report. That's Dr. Mark Faber, talking about what he's feeling about India, as well as this growing turmoil between US and China, which could lead to a fear of tariff wars. But let's take status of the market, and not bad at all. We are in fact closing in on that 10,150 mark. So at the high point of the day, and after having started off sub that 10,000 mark, a very quiet, wobbly start, this big move has really come in the latter part of today's trading session. By about 1 o'clock or so is when you saw this spike up coming in the markets, and this is leading us to the highest point in the day. So not bad at all. But again, you know, these are just expiry-related moves. Don't be fooled by this recovery. For all you know, next week when we come back after a long trading weekend, it could all be gone. But for now, you've got a great market breadth, a good 180 stocks standing to the advances, to just about 30 odd to the declines. HCC, yes, is under pressure. There's GAIL, there's Petronet LNG, there's PC Jewelers, Wipro. These are all names which are looking a little bit bleak. Yes Bank, SBI, Bajaj Finance, HDFC Bank. These are all names, along with ICICI Bank, which are seeing a huge recovery. In fact, as I speak, Yes Bank is backed up a good 6% right now. There's also Maruti, there's L&T, there's a couple of auto names as well in there. Aside of Maruti, there's also M&M, which is holding out very smartly. Bajaj Auto is also looking very smart. The only spaces or pockets of red today, that's technology, but that's okay, because technology has also been very, very resilient in the market volatility ever since February, or correction rather. So there's TechM, Wipro, which are a little bit down. Infi as well is seeing a spot of red. And yeah, OMCs, HP, BP, IOC, they continue to be a little bit weak. We've also got Mahantesh Sabara joining us on the show right now to make sense of the market. Mahantesh, hi, afternoon. Are you using this uptick in the market today to perhaps exit some positions? Do you sense that after, you know, once we're done with expiry settlement, come next week, again, we could get back to some more correction? Because it doesn't seem like the markets have priced all this fear around the global trade tariffs already in.
So, indeed, this is a volatile week, and as far as our advice to clients is, we are asking them to swim with the tide and not really go against the tide. So, if there is a recovery that is being seen, it's partly because of short covering, partly because of this zero LTCG era getting over. These are different pulls. So, one is pulling the market down, the other is pushing the market up. So we are just saying that swim with the tide right now, remain invested before taking any bold calls. The subsequent weeks, we might see the markets actually start pricing in the earnings recovery. I think we're going to have a substantially large earnings growth ahead in this quarter. Quarter four earning estimates are being firmed up by various analysts, and consensus estimates are likely to be on the higher side. So we are looking at that event ahead. So we're not actually telling the clients to sell and go away.
Mantesh, but the tide doesn't seem to be favoring a whole lot in the market besides some of the construction names, couple of these roads, sector companies in particular, or for that matter, IT. Where do you think is the hiring space up until when we actually see a full-blown earnings recovery come by?
Okay, the first and foremost hiding space is actually in the banks. They got so beaten down in this melee that I think banks would have a smart bounce back. Banks suffered not only because of the global trade war fears, we also had the local NPA issues and the fraud issues gaining prominence. I think therefore with beaten down banks, that's the place to really hide, because there's nothing really to lose in such large cap bank names like the IndusInds and the ICICIs, or even the Yes Bank, which has rallied quite substantially today. So that's the foremost. The second sector where one can hide is in the IT space. We have seen that actually IT remained untouched in this entire market correction phase. In fact, we were bullish around December. If you recall, in your channel, I had been talking about our bullishness on the IT space, and that's worked out well, and it still remains a hiding space for market participants. And infra is something that is an interesting sector to look forward to. I was just noticing at one figure for the months of December, Jan, Feb, cement sales growth in our country is up by almost 18% year over year on a like-to-like period. So that tells you that something is really happening on the infra space.
Okay. Sticking your neck out and looking at banks, infrastructure, and even the IT space. Mantesh, hi there, afternoon. Would like to get in your views as well on the consumption theme. You know, a stock like HUL, for example, has seen quite a bit of a correction from the recent highs. Given that the overall demand environment seems to be improving, do you think we could see some sort of a value play emerge within these large cap FMCG stroke consumption names?
So in the FMCG space, we all know there is considerable rooted distress that exists, and therefore it's not easy for consumption companies to really ride with the demand, so to speak. In fact, the demand is rising in the urban space, but not really on the rural space. So therefore it becomes difficult to take a call on some of these FMCG names, but quality, large cap, good company FMCG names who do constant innovation, who have this aspect of premiumization built into their business model, and who generally have the gains of GST flowing in, are the ones that we should be looking at. So if Lever is actually one of them, which you just named. We have also given outstanding calls on such companies as an Imami in this space. So you have to be very selective as far as FMCG names are concerned. You have to broad base your decision, really, then looking at narrow segments of the FMCG space.
It's a convincing up move that you're seeing, 590 points higher on the Nifty Bank, and that's propelling the index to go above the 10,100 mark. Take a look at the broader end of the market as well. 230 points built up on the mid-cap index. The Sensex holding out around the 33,100 mark, thereabouts. Den Networks is spiked up 13%, Canara Bank 11%, Hathway Cables is doing its bit, and MMTC, Adani Enterprises as well as Yes Bank are some of the smart movers. Cadila Healthcare too adding to the pack, but it's been quite a go-getter from the morning session, largely on account of the hectic buying that's one seeing after the analyst community led by CLSA upgraded the stock. What exactly did they have to say, and what are the big factors that are keeping the stock alive? We've got Pankaj joining in to give us a heads up. Pankaj?
Right, Avan, let's look at Cadila Healthcare. As you pointed out, the stock is one of the top gainers. It's up 4.8%. That's not a small move for a company like Cadila Healthcare, and volumes are particularly quite high onto this name. Now let's come down and look at what's happening into this particular counter. So you have CLSA which upgraded, and you have Nomura which upgraded. Let's start with CLSA first. Upgraded to outperform from an underperform rating. 450 is the target price that they have. FY18 estimates now based on FY20 estimates 2 year forward. They believe that the company is looking extremely attractive. Remember, it's been one of the underperformers in the last 6 months as far as the entire space is concerned. Now we come down to Nomura. Nomura was very clearly pointing out that of course it's a big underperformer, which makes the valuation look attractive, but they believe that US markets would essentially do very well, or US markets would tend to do well going ahead from here on for Cadila, with backed by new launches, backed by new therapies, new geographies, and that's why the stock is doing well. 4.7% higher. Two big brokerages like CLSA and Nomura have upgraded the count.
Oh yeah, sure. This has been a big mover from the word go today, and you know why now. Cadila has been a buzzer. But there's also CESC. The demerger verdict is going to be out today. Vivek joins in, and what we can expect. Vivek?
Well, you know, it's a very interesting case, and this is something that we need to understand in a little bit more depth. CESC, remember, you know, just last week we had actually highlighted the fact that the demerger had run into a roadblock, and there were a couple of hurdles as far as the entire power generation segment of CESC was concerned. We had told you how the West Bengal Electricity Authority had actually said that it would be unable to allow all the PPA transfers from CESC parent arm to the CESC generation arm. However, if you're talking about the NCLT process, today, the final court hearing date as far as the NCLT is concerned, and this is mainly for giving a complete and final pass through as far as the demerger is concerned. So this is the reason why, if you're looking at CESC, a lot of value unlocking is expected post this particular demerger. The demerger is expected to come into effect within 3 months. And if the court verdict, does come in favor of CESC, don't be surprised, if the stock actually spikes up further in trade. As of right now, there has been no announcement to the exchanges as to what has been the verdict. However, today is the NCLT hearing, and if the verdict is in favor of CESC, it is one more hurdle passed as far as CESC is concerned towards the finalization of the demerger into 4 separate arms.
Well, any other day we wouldn't have waited for confirmation with such kind of price action, but today there are a lot of stocks which are substantially going up, and CESC too has been showing decent price action, along with more than 12 lakh shares traded as of now, and stock is up by more than 8%. Let's take some more closing trades or more trading ideas at this point of time. And Kunal, Jain Irrigation, now this stock of late has been less volatile. We are seeing some positive momentum today. In fact, yesterday too, from lower levels, yesterday in the sense last trading session, we have seen a decent bounce back from lower levels. What are you seeing on charts?
Yes, Siddharth. So yes, the stock has bounced, or rather taking support or multiple support on this 103, 105 odd zone for I think two or three times over the last 2 weeks. Now I think the stock is making a comeback and breaking the 200 moving average. So that's the first trigger. That earlier support could now be looked at in terms of a short-term uptrend. I would suggest a buy on Jain Irrigation with a very near-term or a short-term target closer to 113, 114 levels. Stoppers could be kept at 106 at current juncture.
Manav, you give all 3 buy calls today. Unlike last few trading sessions, market is not giving up its intraday gains. I'm presuming that you would give us one more buy call when it comes to closing trade.
Yes, absolutely. I think when we are looking at the complete momentum, I think the markets are also seeing short covering and also fresh long build up. I think going forward, this trend is likely to continue at least for next couple of trading sessions. And most importantly, if Nifty manages to close above 10,100, I think Friday's close would be marked as a false breakdown, and this would eventually take the markets close to the levels of 10,200 and even 10,300. So keeping that picture in mind, also a good bounce back from PSUs. I think Bank of Baroda is a good buy at current levels. The stock has seen a good bounce and has formed a double bottom pattern on the daily chart. So the stock has its neckline at 147, and looking at the overall formation, I think we can anticipate a breakout above 147, which is its previous neckline, and the stock could move beyond that. So I think at the current levels, Bank of Baroda can be bought with a stop loss of 137 for an upside target of 155.
Well, before I go to Dr. Nayan, in fact, my producer was just flashing advanced declines, and if I may request to flash that again, we are seeing 135 points up on Nifty, which is more than a percent. We are also seeing a 2%, more than 2% rally on Bank Nifty, and look at the advanced decline ratio. There are more declines than advances. Now, this doesn't mean that this rally is not here to stay, but just that this is not a broad participation. There are a lot of large caps which are contributing to this gain, and there are some mid caps and some semi large cap stocks which are correcting in today's trading session. Dr. Nayan, what would be your closing trade looking or taking into consideration a big move, no intraday correction, but advanced decline ratios are not very encouraging?
Well, it has to be a buy as a BTST trade because the market has been trending well into the close, and we can therefore expect momentum from today to spill over into tomorrow. LIC Housing Finance is something which has been declining for nearly last 5 to 6 months, and that decline seems to have come to some sort of a closure with the fall of last week, and now over the last few days we are seeing some upward price action which seems to continue into today, and the stock has looked up once again. So I would recommend a buy as a BTST in LIC Housing Finance at the current levels, and I would maintain a stop loss at about 537, 538, and we can look for a price target about 560.
Another housing finance company there on the radar, holding out at the high point of the day. That's LIC Housing Finance for you. Mantesh, would just like to get a cue from you as to how you're viewing the overall capital goods space, with the commentary coming in now that orders are picking up, that we could see some meaningful recovery as well in some of the potential orders for some of these companies. How are you looking at the prospects for the capital goods space from an earnings standpoint?
So on the capital goods front, what we have been seeing is, you are right, there is an order pickup. More particularly, if you'll notice that there has been a substantial uptick in building of metro rails across the country. It's not just in Mumbai. Unlike a traditional railway package, a metro package comes with a much higher value-added content, and there is wider participation to be seen. And therefore, right from AC makers to the coach makers to electrical equipment suppliers, etc., all stand to gain, unlike the railway orders where it is traditionally the construction companies who tend to gain. So we are seeing that happening. We are also seeing industrial activity actually pick up. I did mention about cement cement sales going up substantially higher, and that's indicative of the fact that a lot of infrastructure-led building activity is happening. We don't know whether it is for roads alone or factory and buildings and some other infra projects, but suffice to say that associated capital goods companies are seeing an uptick. In fact, you can even see uptick in commercial sales, in agricultural tractor sales. Mind you, agricultural tractors are also used for commercial construction activities. So these are something that we have been noticing lately, and we're quite looking favorably at capital goods companies right now.
Okay, that's the word coming in on cap goods companies. By the way, you are seeing quite a convincing pickup for the broader end of the market as well. Interestingly, the mid-cap index is seeing its biggest intraday gain since the 23rd of February, and the PSU banking index is seeing one of the biggest intraday gains as well. This is since the 25th of October. Would like to get in a view, Mahantesh, as to what the outlook is on the rural theme, because the consensus call on the street seems to be that in an underperforming market such as we're seeing right now, sectors that are exposed to the rural theme such as two-wheelers, cement, consumer staples, they would tend to do relatively better, largely on account of an increase in the rural spend running up to the general elections as well. Is that a call that you would also take? Would you also jump on the bandwagon and say that the rural theme is looking fairly promising?
Okay, when the budget was presented, if you recall, there was a lot of optimism about the rural theme really playing out, because the government was stressing about how agricultural income or farmers' income has to go up, and they were guaranteeing a substantial increase in farmers' income, and there was a whole lot of debate about the implementation of the Swaminathan Committee report. But having said that, the reality now seems to be that while the rural distress seems to be still continuing, it's the semi-urban to urban actually which is really picking up relative to the rural space. So I wouldn't say that the rural theme is really working out, although if you had asked me this question around the budget time, I would have definitely answered in the positive. So right thing is that it's the semi-urban play which is doing relatively well. So your scooters actually outgrowing the motorcycle sales, right? So that's a simple enough metric to really observe what's happening with the rural theme play. On the broader macro front, the cue that seems to be seen is that the prices of agro commodities or farm-based commodities, food inflation is actually tapering down, and the forecast seems to suggest that it is likely to remain subdued. So therefore, you wouldn't see substantial increase in the rural demand or rural consumption activity, although some portion will come from the government spending. So right now we are not really looking at the rural theme. I did mention in the earlier part of the show that we are looking at some FMCG companies who have a broad-based appeal, not a very sector-specific or segment-specific approach. So we would rather take a cautious call on the consumption space right now.
Okay, fair point, Mahantesh. Hold on with us, and we got lots more to talk about with you. Try to analyze what lies ahead in the trading week and how the day has been. For now, though, it's been an impressive close, much awaited green. It's coming after a long haul. So we've made it comfortably back above the 10,150 mark. It's remarkable considering it's been over 150 point move that you've seen from the lows of the day, considering we started off sub the 10,000 mark. A good reversal. Having said that, this is just pre-expiry adjustment, which is why you're seeing a massive short covering led bout. It would be a little naive to believe that there is a trend reversal in place and that what we saw last week was like any sort of bottom formation. That's too really early to try and take that call. But nonetheless, for today, it's been Yes Bank, SBI, Bajaj Finance, Tata Steel, Zee, Vedanta, HDFC Bank. They're the ones which have come to the rescue of the index. On the flip side, the losses were restricted to IT and some of the OMC names. So GAIL, IOC, HPCL, these were down, and you had a Wipro as well as TechM and Infi, which were a little bit soft. Canara Bank has been a big mover from within the broader markets. There's been Adani Enterprises, which has held out very well. CEFC, ahead of the demerger announcement, is up 8%. BOB, JP Associates, and largely some of the big losers from last week, they're the ones which are rebounding. Bosch has gone home a loser, just about a little bit soft, but has seen a huge OI build-up. That's pretty much the case with MRF, which goes home with a 1.5% gain, but fair amount of OI build-up. Axis Bank as well, and Colgate and Equitas as well have been very active, have seen fair amount of OI build-up. On the flip side though, HCC, GAIL, Wipro, Oil India, MCX are where the losses were concentrated. But not bad at all, Avan, today's rebound.
Yeah, you're taking a 180-point rebound from the low point of the day. So intraday, it's been quite a phenomenal recovery, a very healthy market breadth at your hand. 10,137 is where we shut shop. We're talking 470 points on the Sensex, 33,066, and the broader end of the market too has played catch up. So the mid and the small cap indices firmly in the green. You flagged off a number of stocks. I'm just going to add to the list with some of the interesting movers that catch the eye. You have Den Networks, which has been a great mover toward the fag end. Something like a Hathway Cables picked up steam. Remember, MMTC has been quite a mover from the word go, largely on account of those comments that Suresh Prabhu says that the merger for STC and MMTC is on the cards. You've got an IB Realty as well that was a newsmaker today, selling their Chennai residential and commercial assets and the demerger of the rental and residential business as well. So that's been a newsmaker today. We flagged off Cadila with those two upgrades coming in, and CESC, the hearing on the demerger, the verdict, that's going to be awaited. So those are some of the newsmakers. Century Ply flexes its muscles. Bajaj Electricals has a stellar run. Bajaj Holdings, Just Dial, Varun Beverages, as well as Future Lifestyle. Those are some of the standout performers, while Unichem sulks. HCC is in the red. Bajaj Hindustan is tempered. Wipro, eClerx, Info Edge, those are some of the mid-cap IT companies too that have seen a bit of a thumbs down. But Siddharth, I don't think at the start of the session that one would have anticipated this kind of a ferocious recovery.
Certainly not. Though one would have anticipated that you may not see substantial downside below 10,000, but market would cross that zone of, or will reach that zone of 10,120 to 10,150, which we're talking about in beginning of today's trading session in one single day. That is something surprising. Are we only markets which are doing this, and are global cues also same? Answer to that is no, partially no. Asian markets are not doing that great. They are up by 0.5 to 0.7%. European markets, which have closed yesterday or on Friday's session with huge cuts, these markets are also up by in a range of 0.5 to 0.3%. So now that everything is going up globally, it is just our markets which are outperforming at this point of time. But yes, Dow Jones Futures is up by 280 points, which is around 1.2% to the base. So Dow Jones Futures and Indian markets, these are two markets which are doing really well at this point of time. From options perspective, it is very important to understand that those call writers of 10,000 and 10,100 strike price, some of them have decided to cover their positions, and that's the reason, despite market going up, implied volatility for those call options have increased to 17%, which means those were writers and they are covering their position, and that's the reason you are seeing that implied volatility is going up. 10,000 and 10,100 put options have seen rise in open interest. So it is quite possible, and at this point of time, a bit easy also to say that 10,000 for this expiry would hold or might act as pivotal level. Let's understand from our experts that how they have read into this massive up move in today's trading session, which seemed to be like short covering, but not just short covering. Some of the names have done really well and have added long positions. Dr. Narayan, your take on this and how you will position yourself when it comes to index trading?
Well, I think today's price action was one of a little bit of surprise. Over the weekend, I think most of us had got prepared for expecting a really bad start for the week, with the index suffering a deep cut. And then we were presented with a situation where the market actually began with, almost flat, with the index trading at 10,000. So I think most of the market men spent the first about 30-45 minutes trying to just come to terms with the opening, that it was not as bad as they had expected. And my belief is that since a very large amount of positions had already been cut by Friday, because it was very, very evident last Friday that things would only be worse when the market starts this week. So I think most of the positions were cut. So I think the rest of the day today has been spent either replacing those positions, and then there would be many who were adventurous and went short on Friday or perhaps today morning, or averaged their shorts today morning. I think those people have also spent the rest of the day covering their shorts or reducing them to a good extent. So I think today was a day when there was a substantial amount of buying, nothing very aggressive, but then quite consistent through the day, which is why we are seeing the indices with the kind of gains they are. Now, will this repeat into tomorrow and day after? I would think not, because once that initial surprise element is gone, then tomorrow and day after will require additional inputs by way of news and order flows to keep this kind of momentum going. Also, we cannot overlook the fact that we have only 3 trading sessions and Wednesday is also expiring. So I think all other considerations will also start getting mixed in. So my belief is that the kind of price action that we saw today is quite unlikely to repeat over today and over tomorrow and day after. So if you get better prices tomorrow and you're long in something, my suggestion would be to take your money off the table.
Okay, lighten up your positions if you get more, gains from current levels, and as he said earlier, that wait and watch approach would be a better option, and what Nifty does next week, that would be, more important in terms of determining the direction of this market. But Kunal, Bank Nifty has done really well. 600 points is very substantial. You are referring to, 2, days when Bank Nifty was down, and especially on Friday there was a gap which was created, and today's move, that big green candle has filled that gap and engulfed these 2 candles. What are the implications, as you are pointing out this observation? Does that mean that the reversal is here?
Well, yes, Siddharth, first, I think is where one has to understand that gap filling is a very positive exercise, especially if it's a down gap which is getting filled almost on a subsequent immediate day. So that goes to show that the power of bears, or the power of immediate bears, has been countered very well by the bulls. And the fact that we've closed at the high point of the day, the candlestick pattern is extremely bullish. I think has strong bullish implications on the near term. Now we are still trading below the long-term averages for both Nifty and Bank Nifty, but just looking at the power of the candle today and the engulfing pattern as well, not just a gap but even the engulfing pattern today, because we've engulfed 2 days of the Bank Nifty move, 2 days on the downside of the Bank Nifty has been engulfed in one single day. So that goes to show that even if it's a short-term rally, this rally could probably power ahead another 400-500 points at least on the Bank Nifty, and that should probably take it somewhere closer to the 200-day moving average. So all in all, I think the summary is that the move is quite bullish today. It's just that we've seen a lot of PSU banks rising today. Hopefully tomorrow the private sector banks also add one more leg on the upside. You could see more credibility to the Bank Nifty move.
Okay, so this is a big move which has taken place in Bank Nifty, and it has a lot of positive implications according to Kunal. So interesting times ahead for Bank Nifty and market overall. Mahantesh, before we thank you, commodity prices are moving higher despite markets not doing so very well. How do you think the prices, high commodity prices, would impact some of these sectors where commodity as a raw material has a larger share? Case in point, auto space, or some of the other sectors where commodity as a raw material is quite a meaningful cost.
So it's but natural from a demand supply perspective that globally, when you have economic recovery happening, global commodity prices tend to rise higher. So there is no financial market linked interlinkages here. It's pure demand and supply dynamics that tells us that. So in such a situation, rising commodity prices obviously hurt Indian economy because we are net importers of commodities, and there are enough sectors who have therefore earnings pressure coming in. You rightly named one of them is autos. There is also an FMCG, for example. They are dependent on crude related derivatives for some of their items that they produce. So we will have this earnings pressure getting created by commodity push, but there are efficient converters. So you have on the metal side, for example, particularly non-ferrous metal side, or even the refiners, for example, rising commodity prices actually enhances their ability to convert because you also have the prices of the finished products going up. So between these two, these 3 plays that I mentioned, Indian markets will be weighed down by the commodity push earnings incremental delta, and therefore is not favorable for our markets in the interim.
Okay, that's a view of Mahantesh when it comes to some of the sectors which might see some unfavorable scenario due to rising commodity prices. Thanks Mahantesh for joining us, and thank to all our technical experts, Dr. C.K. Narayan, Manav Chopra and Kunal Bothra, for sharing your trading ideas with our viewers. Let's take a short commercial break. On the other side of the break, we'll dissect this market and we'll discuss whether this is bottom formation process or just a one-day wonder.